So let's go around the world here. We can go east to west. Let's start with China and kind of the liquidity there. What are you seeing?
Yeah, absolutely. So China is kind of bucking the trend if you as it relates to global liquidity. So right now, the Chinese liquidity impulse that's chart five there is actually currently negative, only modestly negative. But they've done a series of measures in recent weeks that gives us confidence to say that that modest negative impulse is likely to inflect positive in the coming months. So they cut their 7-day their benchmark 7-day reverse repurchase rate by 10 basis points. The PBOC did last week. They also cut their 1-year medium-term lending facility rate by 10 basis points last week. We've seen follow through by Chinese banks this week. They're cutting their 1-year and 5-year loan prime rates by 10 basis points. And, this kind of mirrors the series of easing measures we saw kind of in the middle to second half of 2022 that really helped the Chinese liquidity impulse kind of inflect positively alongside, obviously, a lot of PBOC open market operations and medium-term lending financing itself. And so that's something we would expect to see over the coming months. And obviously would be a positive from a global liquidity perspective, given how dominant the Chinese economy is in that matrix. But the issue there is that you have liquidity impulses in the U.S. is likely to deepen. The negative liquidity impulse in the U.S. is likely to deepen in the coming months. Eurozone is likely to inflect negative, and Japan potentially may become negative and deepen as well. So we can unpack each of those separately.
Go now to the United States and their liquidity. What are you seeing there? And it almost feels like it's going to be opposite of China.
Yeah, absolutely. So clearly, I mean, our liquidity cycle has been negative for quite a while now. It's no secret to anyone. Fed's obviously doing quantitative tightening. Clearly we have an issue in the banking sector as it relates to extending credit. Certainly not extending credit nearly at the pace that we had been in recent quarters. And so that's likely to get worse in our view for a couple of reasons. One, we have clearly the rebuild of the TGA. We've talked about this months ago, so it's no secret. I think it's pretty consensus now. That's draining liquidity at the margins because we have not seen the decline in the reverse repo facility balance fully offset the rise in the TGA. Treasury Secretary Yellen, which is something we've talked about maybe a month or two ago on the program, it did a good job of kind of concentrating T-bill issuance, kind of really, hitting the market heavy and hard with T-bill issuance, a very short-dated T-bill issuance to kind of drain a lot of funds out of the Fed's reverse repo facility program and transition those into the TGA. So that's obviously offset the rise and the potential drain in liquidity that we've seen in terms of the rise of the TGA post-debt ceiling. That process is not being fully offset. So at the margins, you're seeing a little bit of decline in liquidity in the U.S. But what I think is the bigger issue and the more structural issue is the fact that we're running with these sort of record non-war, non-recession budget deficits in the U.S. economy. We are currently tracking at -8% of GDP as it relates to our budget deficit as a percent of nominal GDP. This the most recent month is May that we have the data for. And so what that ultimately means is that they're going to be issuing a lot of debt regardless. And the reason we bring this up is because the Fed has been doing quantitative tightening on autopilot in recent months. To recall that we hit the debt ceiling in mid-January and really haven't issued net debt on a net basis since then. And so the return of Uncle Sam to international capital markets is likely to coincide with a significant uptick in coupon issuance from effectively net zero to something that's a lot greater than net zero in the context of this structural deep negative budget deficit. So this is, in our opinion, it's going to give quantitative tightening its teeth back as it relates to potentially draining bank reserves again, which is something quantitative tightening has not done since the beginning of the year, the very, kind of middle of January. So this is something we're calling out as potential, as a very likely negative impulse on global liquidity in the coming months.
Let's jump back over to the Eurozone. Obviously, the liquidity there, they kind of seem to be doing their own thing to some degree. But what are you seeing on that front?
Yeah, so last week was a big week, right? We got the Fed on Wednesday, the Eurozone on Thursday, China on Thursday, and then the PBOC on Thursday, and then obviously the Bank of Japan on Friday. So as it relates to the Eurozone, we got a lot of important updates as it relates to their liquidity cycle. Obviously, they hiked interest rates. Madame Lagarde was extremely hawkish with respect to the guidance, which allowed terminal policy rates, with respect to ECB to back up pretty meaningfully week over week last week. And so, the ECB is doing a good job of kind of pushing through tighter interest rate expectations through the kind of global financial system. But one thing that's also they called out last week is that, we got 477 billion euro, so over $500 billion of pandemic related financing for banks that's going to mature next month, that they're not going to roll over. So we know the ECB's balance sheet is going to decline by roughly $500 billion next month. but we also have them no longer reinvesting the proceeds from their asset purchase program, which is about $3 trillion thereabouts. And so that's, it's not quite QT, but it's certainly that balance sheet runoff is going to be kind of negative from the perspective of global liquidity out of the Eurozone. So it's very likely that this kind of very modest, we're more or less flat, this very modest kind of positive trailing 3-month impulse in Eurozone liquidity is likely to go negative and get potentially very negative in the coming months, particularly around this summer.
Can you talk about Japan? You mentioned them earlier. What's going on with their liquidity?
Yeah, absolutely. So Japan is a kind of an interesting wild card, right? So the Bank of Japan stood pat on its yield curve control program last Friday. Governor Ueda continues to kind of anchor on wages as opposed to inflation as what's really driving that process. But we also know that if you look at their forecast for inflation in Japan, particularly for the current fiscal year, they're down at 1.8%. Whereas, if you look at where core CPI is tracking in Japan now, it's about 200 basis points higher than that. And so we know that when we get to July, which is when they're going to publish their updated version of their summary of economic projections, the Japan's version of that, it's very likely they have a significant positive revision to their inflation forecast. Now, if that significant positive revision to the current fiscal year inflation forecast is married by a meaningful positive revision in the out year inflation forecast, it's very likely that they're going to have to start, talking about, or at the bare minimum, tweaking yield curve control again. I don't know if that we know enough that they're going to do it in July, but it's certainly something that could potentially happen in the coming months. Maybe it happens in September thereabouts, as it relates to potentially kind of changing that program. And why that's relevant for global liquidity is because if Japan alters its yield curve control program, it reduces the amount of pressure that the Bank of Japan will have in terms of defending the yield peg in Japanese bond market and ultimately in the global bond market. So this is something that, you go back to kind of the fall of last year into the early part of this year, the defense of that peg was one of the things that really caused global liquidity to really spike higher, from Q4 to Q1 of this year. Right. And so ultimately, if we don't have that kind of market speculation, because the peg is more, I guess, in line with global sovereign debt yields, then ultimately you might see Japan's liquidity impulse kind of get incrementally negative in the coming months. So, when you sum it all up, you have Chinese liquidity is going to be improving. We pretty much know I wouldn't say there's no certainty in financial markets, but there's a reasonable degree of a reasonably high probability that liquidity in the U.S. gets worse from here in the coming months. The liquidity in the Eurozone gets worse from here in the coming months. And there's a strong possibility that Japanese liquidity may get worse in the coming months. And so when you add up what's happening in the US and the Eurozone alone, it's likely to offset what we're likely to experience in China. But when you layer on Japan, which is obviously a very large economy in and of its own right, that may actually kind of make that offsetting process a little bit worse and may potentially cause, some volatility in asset markets this summer, which has been our baseline view. I don't think this is the end of the kind of bull run that we've seen really since the fall of last year, because ultimately we still think the average investor is very much offsides with respect to the timing of recession. We've been you and I have been talking about this for a long time now, but we have been since the last summer of the view that a recession, if it was going to commence in the U.S. economy, that Q4 of 2023 was the highest probability outcome. With the second highest probability outcome of a recession starting in the U.S. economy is Q1 of next year. And the reason that's important as it relates to understanding the market cycle is that asset markets tend to squeeze very aggressively into the end of the business cycle. The median return on the S&P 500, if you go back and look at the 12 recessions, post-war recessions that we have, the median return to the S&P 500 in the year leading up to the peak and around the recession is plus 16%. With an interquartile range of 14 to 20%, plus 14 to plus 20%. There are no non-double-digit numbers in that entire 12 cycle sample. So this is with that understanding, we understand that if we're right on the timing of recession being Q4 or Q1, we could see markets rallying to, October or even January between now and then. So ultimately, we do believe this correction will be bought this summer. If we're right on the liquidity cycle, we're right that we get a correction as a function of the deep, kind of adverse liquidity cycle developments. And ultimately, you probably want to buy a dip heading into year end, or maybe even to your Q4 year end, because ultimately we're not quite ready for that recession phase 2 credit cycle downturn.